Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. Here is your weekly commentary, technical analysis commentary of Chicago wheat and corn. I'll start with Chicago wheat. Since the market entered May, it has shown some interesting patterns and their resultant moves. Now, from mid-March, we've seen the formation of two patterns. Firstly, a reverse head and shoulders pattern. Secondly, an ascending triangle. The ascending triangle has been constructed in between the uptrend, currently at 1116, and the flat-ish trendline top, 1149. The reverse head and shoulders pattern had a primary target in the 1270 area, with a harder to get secondary target X1 in the 1320 area. This latter one is coincident with the March 2008 high. The ascending triangle pattern had a primary target X2 in the 1270 area and a secondary target X3, a harder to get target, in the 1320 area. As you can see, the primary and secondary targets for each of these patterns are the same. It's not often that such things happen, but they have done here. The next thing to note is, which to be honest is pretty obvious, is that targets X and X2 were reached on the 17th of May with an unusual key reversal up, which was also an indecisive spinning top, but with a long tail on it. I mentioned after this was reached, and I quote, "It very much looks like, at least for now, that prices have achieved what they needed to on the top side, and we're now seeing a move back down to gather ammunition," end of quote. Thus, I will retire all targets on the upside after this commentary. The questions I posed last time were twofold. How far will the market fall, and will it possibly turn into a fully bearish move instead of just a pullback down? So, there were four areas to look at for a pullback. Number one, the very recent 50% Fibonacci line at 1166. Number two, the upper trend line stroke neckline of the ascending triangle stroke reverse head and shoulders pattern, currently 1151. Number three, the congestion area 1104, 1125. That has a short medium moving average just below it, currently at 1100 even. And finally, four, what was at the time below all the previous supports, the lower trend line uptrend of the ascending triangle. That's currently at 1116. There was an additional area below this, which I mentioned, which is the 50% Fibonacci line for 2022 at 1051. But I was reserving judgment on that back then. Any of those four previous areas could have halted the move lower and turned back prices back up again. And I added, and I quote, "However, the last one being broken, the 50% Fibonacci line at 1051 could trigger the beginnings of a bearish incentive," end of quote. Well, since then, we have dropped down through all four support areas and turned them now into resistances. It has been the last chance saloon support of the 50% Fibonacci line of 2022 at 1051 that has managed to hold up the market. Though last week, and to a certain degree this week, we've seen approaches of this support, if not outright testing. So far, it has held. So what is next? Well, there's some interesting action going on here. You see, overhead, we have the resistance of the flatlining short-medium moving average capping the market, helped by the Fibonacci and other base congestion zone between 1105 and 1125, plus the broken trend line of the ascending triangle, currently 1116. So that seems pretty good resistances. So what have we as support? Well, apart from the 50% Fibonacci line, we currently don't have much. But moving up swiftly into the frame, we have the medium moving average, currently 1023. And that could very well fortify the 50% Fibonacci line quite well. Beyond these two on the downside, we have stratified support areas all the way down. And they're as follows at 1016, 1003 down to 999, and 959 to 978. Whilst there are specific levels in there that are quite interesting, it is worth looking at the whole picture because it is this stratified levels of support that eroded the fall in March, such that by April the market was ready to rise again. Now, I'm not saying that may happen again automatically, but it is worth remembering. Chicago corn. First off, please kindly continue to ignore the color change on some of my labeling. This is something to do with my charting system occasionally does without my permission. There is no special quality attributed to different colors. Okay, So the move up to the heights of late April can be attributed to one key action, which subsequently led to many others. The key action was the almost weekly key reversal up that happened at the end of March, but which ended up being a lesser outside week pattern instead. That week was also a spike bottom, which along with the earlier pipe bottom in mid-March formed a double bottom, thereby causing prices to rise. The rise continued until the weekly key reversal up made 6 weeks ago, when the hubris of the market met its nemesis. The reason of the lack of further bullish action can easily be seen, and one that I've spoken about some time before. It is the middle time overhead, currently 850, of the April 20 to September 21 bullish Andrews pitchfork. You can see how this had been used as a rolling higher resistance back in early March, and then again at the end of April. The result of all this was a fall in prices almost all the way down to the lower time, currently at 688 of the same bullish Andrews pitchfork. And that was last week. On the way down, prices broke through the following supports. They are now resistances. The congestion at 789, the October 2012 high at 776, the November 2012 high at 768, the short medium moving average currently 761, the February 2013 high at 747, the May 2021 high at 735, which is currently coincident with the November 21 to February 22 upper bull channel line, currently at 736. We also have seen moves below the following that since last week have reasserted themselves as support due to the market moving back up. The medium moving average, currently 723, the March 2013 high at 719, and the interesting 61.8% Fibonacci line of September 21 to April 22 move at 700 even. What is most interesting here is that with all these moves lower, the original April 20, September 21 bullish Andrews pitchfork that started this whole move higher last year is still valid. Hence, despite the moves lower, nothing has changed in the picture of this longer term bullish pattern. All we are seeing is still a pullback in an overall bullish scenario, at least for now. I had to add that last part, for now part, as you never know, but realistically we are still within this bullish scenario. And one other final point. Just off the top of my daily chart is target X in the 890 area. This I drew back in March and is the target for the May 21 to date action being a rounded bottom pattern. I'd highlighted this pattern back in March and it's still good. It's just, well, it's an awfully long way from where we are now. Thank you for listening. This weekly broadcast gives essential market patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyright Tofpik and ADM Investor Services International Limited. And here comes the final bit.